Hi, everyone. We are going to continue talking about problem 6. I apologize. I didn't realize the first video just stopped. So I'm coming back to requirement 4 on page 102. The unadjusted trial balance is where we left off with our last video. So let's take a look at requirement 5. It says prepare and post adjusting entries. So remember, adjusting entries are those entries that we do at the end of the time period we're getting our financial statement together for, to make sure any revenues that are missing are recorded or expenses. So it seems we have accrued salary. So remember, accrued means it occurs, but it has not been recorded yet at year end of $1,000. So to record that, we want to debit our salaries expense because these did occur, but since we're not paying them on December 31st, we will credit the liability salaries payable. So that's a common adjusting entry. And the second one is depreciation for the year on equipment is $2,000. So remember, we debit depreciation expense for the $2,000. And then we credit the contra asset accumulated depreciation for $2,000. Remember, that's where we keep track of all of the depreciation ever taken on this equipment. It's a contra asset because it increases on the opposite side of a normal asset, and it always has a buddy. In this case, it would be the equipment account. So we're going to post those two journal entries to our general ledger. So here is, okay, wait a second, I went the wrong way. And here's our general ledger. Now you don't have to keep rewriting your general ledger. They just do it in the answer key to show you how it keeps updating. In the real world, we just keep using the same old general ledger. So here is item A. Here we go. Salaries expense, adjusting journal entry, debit, salary expense 1,000, and we will credit our liability right here, 1,000, salaries payable. Then we have our debit in depreciation expense of 2,000, and then our credit in accumulated depreciation 2,000. So we will update those unadjusted balances for those two adjusting journal entries. So our cash doesn't change, our accounts receivable doesn't, nor does equipment, but accumulated depreciation now has an $8,000 balance. Salaries payable has an $1,000. Common stock retained earnings, dividends remain the same, as well as service revenue and miscellaneous expense. But now we have these two missing expenses increased. Depreciation expense now has a balance of 2,000, and now we have salaries expense of 42,000. So those were the only items that were expenses that were missing, and there were no revenues that have been earned that are missing. So we can move on now after we post our adjusting entries to our adjusted trial balance, which again is just a list of all of our accounts with their most current balances. In this case, the adjusted balances. So if you compare this trial balance to your unadjusted trial balance, you'll notice accumulated depreciation now has an $8,000 balance. Salaries payable has a balance. Salaries expenses increased to 42,000, and our depreciation expenses increased to 2,000. Make sure debits equal credits. It's this trial balance that we use to prepare our financial statements. So they're asking us to prepare the income statement and the balance sheet, just to practice the cycle. So let's take a look. Our income statement here, remember, we're just including revenues and expenses. So we have service revenue off of our adjusted trial balance of 1,000. Now, when you're doing your income statement, remember it's for a period of time. So you want to make sure you have for the year ended December 31st. And then we list each expense under operating expenses and total those up from our adjusted trial balance and subtract our expenses from our revenue. And I'm sorry, this goes to a second page here. Let me do this. There we go. So we have it all in one page. It's a little off center here. Net income should be over a little bit. But when we subtract operating expenses from service revenue, we get a positive result, which is net income. So remember, that's our income statement. On the balance sheet side, remember, we're always doing a classified balance sheet. That's where we categorize assets and liabilities as either being current or long-term. And remember, long-term assets have subcategories. So if we look up at our adjusted trial balance, our assets are cash, accounts receivable, equipment, and accumulated depreciation. So I'm going to start my balance sheet with the name of the company. And remember, the balance sheet is as of a specific date. So this is December 31st, 2021. The first two assets are current assets, those assets that will be used up or collected within the next year. So by December 31st of 2022. We add those together, the cash and accounts receivable, and label the total current assets. The only long-term asset this company has is in the category of property and equipment. Remember, those are tangible assets that we use for more than a year to produce revenue. Equipment. Equipment is listed at its balance or cost of $35,000, and then we subtract less the contra asset accumulated depreciation, and the balance in that is $8,000. When we subtract that, the result we call book value is $27,000. It's that amount that's added to our total current assets to get total assets. We then list our liabilities between current and long-term. Now back up on our adjusted trial balance here, the only liability this company has is salaries payable. So we'll just have current liabilities and salaries payable, and we will also label total current liabilities. Then in shareholders' equity, because this is a corporation, first we list the balance of common stock. Then we need to find a new balance of retained earnings. We don't do a statement of retained earnings here, so we're going to have to do it manually. And you could see down below at the asterisk, it says, take the beginning balance of retained earnings, its current balance, which is $9,500. Remember, retained earnings increases for revenue, decreases for expenses. Well, we've already summarized those revenues and expenses, and we have a positive $32,000 in net income. So we add that. And then we subtract any of the profits that have been paid in dividends, which is the $2,500. So the new balance in retained earnings is $39,000. So we just list that on the balance sheet, add it to our common stock. Total shareholders' equity is $89,500. We add that to our total liabilities, which is $1,000. Total liabilities and shareholders' equity, $90,500. It agrees to total assets. So our balance sheet is in balance. Once our financial statements are done in an accounting cycle, remember that's our 1-year period, we're now ready to close our books for the year, which basically means we're going to do closing journal entries to reset temporary accounts to zero. Remember, temporary accounts are those accounts we only collect information in for a year. And at the end of that year, we reset them to zero for the next year. And these focus on revenues, expenses, and if you keep a dividends account. Remember, those are all part of retained earnings. So at the end of the year, during the year, we keep those accounts separate so that we can collect just information about those items in that account. So that it's very easy to do the financial statements. At the end of the year, though, when we're finished doing the financial statements, we can now return those balances into retained earnings. And that's exactly what we're doing here. Now, back in your accounting 111 and 112 experience, you might remember we used an account called income summary during this process. Thank God your author doesn't do that. In accounting, just close it to retained earnings. That's where it should go anyway. So we must now move the balance of each revenue and expense out of its account and into retained earnings through our formal journal entry process. So if we go back up to our general ledger as it stands, service revenue currently has a credit balance of 100,000. So to get that account to zero, we must debit it. The offset would be to retained earnings. So credit retained earnings for that 100,000. Currently, all of our expenses, sorry if I'm making you dizzy here, but all of our expenses have debit balances here. Okay, we need those balances to be zero. To achieve that, we must credit each expense individually and then debit the retained earnings for the total. And I'm not going to scroll back up, but we do have a dividends account that currently has a debit balance in it of 2,500. So we want that account to be zero, so we will credit it and then debit the retained earnings. So there's our closing journal entries, and then we will post them into our general ledger as it stands. So let's take a look. Here is our debit to service revenue, first journal entry, and then it's credited to retained earnings. The second closing journal entry, credit to miscellaneous expense, credit to depreciation expense, and credit to salaries expense. Notice all three or four of those accounts are now at a zero balance. We debit retained earnings for the 68,000 total expense. Finally, dividends, we credit that. The account will now have a zero balance, and we debit retained earnings. So we've moved all of the individual accounts that affect retained earnings, their balances into retained earnings, and now those individual accounts have zero balances and are ready to start accumulating information in them for next year. When we balance our retained earnings account, notice it has a $39,000 balance, just like we reported up here on the balance sheet, right in here. So let's make sure our general ledger is in balance. Debits equal credits. And we do that by our final requirement of our accounting cycle, the post-closing trial balance. So again, we're just going to list the accounts that currently have balances with their balance. Assets all have balances, and you can see them all there. The liability, our common stock, and our retained earnings. Revenue and expenses are zero, so we don't have to list them. They have no effect on our trial balance. Debits equal credits. Make sure you total both sides. Once we prove that, now we're ready to start the next accounting year. So that was a great problem to practice, really, those first 4 chapters of Accounting 111, the accounting cycle, from beginning with that very first transaction at the beginning of the year, posting, creating an unadjusted trial balance, creating adjusting journal entries, posting those journal entries, creating the adjusted trial balance, then the final product, which is our financial statements, and then cleaning up that year to get ready for next year's accounting cycle. The second problem I wanted to look at with you is just on adjusting journal entries on page 102, and that's P2-7. In here, we have the information necessary for preparing the December 31st, 2021 year-end adjusting entries for Vito's Pizza Parlor appear below. So we need to prepare the necessary adjusting journal entries that would result from each of these situations. On July 1st, 2021, the company purchased 10,000 IBM Corporation bonds at face value. The bonds pay interest twice a year on January 1 and July 1. The interest rate is 12%. Now you can see the answer there. So what this is asking is, do we need to do anything with this interest by December 31st? And the answer is yes. So we bought this bond as $10,000 as an investment. It is accumulating interest revenue to us every day from July 1st through December 31st. It's just we don't record it usually until we actually receive the cash. That doesn't mean we haven't earned the right to it by the end of the year. So since we earned this interest by the end of the year, it should be recorded this year as interest revenue, even though we're not going to receive it until tomorrow, which is the new accounting year. So we figure out how much that will be. Notice 10,000 face times 12% times 6/12. 12% is an annual interest rate. We only need to calculate 6 months of 12 months of interest, or 1/2. So on December 31st, we should complete an adjusting journal entry, crediting interest revenue for that 600. And since we're not receiving the cash today, debit the asset interest receivable to show that is owed to us. Let's look at B. Vito's depreciable equipment has a cost of $30,000, a 5-year life, and no salvage value. The equipment was purchased last year, or 2 years ago, I'm sorry. Straight line depreciation is used. So they've calculated depreciation for 2019 and 2020. So we're only in the 3rd year of its life. So 1/5, its total life is 5 years. So we calculate annual depreciation by taking the cost minus the life, the full life of the asset, which is 5 years. So in 2021, on December 31st, we should debit depreciation expense for the $6,000 and credit accumulated depreciation, $6,000. In Part C, on November 1st, the bar area was leased to a tenant, Jack Donaldson, for 1 year. On that day, Vito received $6,000 representing the first 6 months' rent, and he credited a deferred, you know it as also as unearned rent revenue, which is a liability. So remember, when we receive money before we provided the service, we credit a liability, either unearned or deferred, in this case, rent revenue. So this was for 6 months. Now the question is, did he earn the right to any of that money, Vito's, by December 31st? And the answer is yes, 2 months worth. So on December 31st, credit rent revenue for that $2,000. Debit the liability, deferred or unearned rent revenue, $2,000, because Vito's no longer owes that money the customer paid early. April 1st, the company paid $2,400 for a 2-year fire and liability insurance policy and debited insurance expense. Ooh, so this is tricky. So here's what I suggest you do. I'm not going to have it on the screen, but I suggest you grab a piece of paper and a pencil like I am right now and draw a T account. And label that T account insurance expense. So what this is saying is the day they paid this, on April 1st, they debited the expense, $2,400. Well, remember, when it comes to expenses, we can only record them when we actually received the service. And that's not the case here. So on April 1st, when we paid $2,400 for 2 years or 24 months, so we'll divide that by 24 of insurance, the premiums for each month's insurance coverage are $100 per month. So the question becomes, how many months did we actually receive insurance for 2021? Well, April, May, June, July, August, September, October, November, and December, or 9 months. So if we multiply that $100 times 9, how much insurance expense should we have? $900. How much do we have? $2,400. So we're going to have to credit our insurance expense account $1,500 and debit prepaid insurance, because $1,500 of premium is still owed to us for coverage for the next year and 3 months or 15 months. So if you're like, well, why'd they debit insurance expense? Well, not everybody understands that there's prepaid insurance, but you do as an accountant. So sometimes things will be put in the wrong place, like in this case, and we've got to move them so that they're properly recorded. And that's what's happening here. On October 1st, 2021, in Part E, the company borrowed $20,000 from a local bank and signed a loan. Principal and interest at 12% will be paid on September 30th, 2022. Well, that's great, but remember what we said about interest. Interest is occurring constantly. So the question is there any interest expense from October 1st to December 31st? And the answer is yes, October, November, and December. So we need to record interest expense for 3 of those months. So take the principal of the amount they borrowed, $20,000, times the annual interest rate of 12%. Since we only need 3 months of interest, multiply that by 3/12. So interest expense debits $600. Since we're not paying it on December 31st, we owe it, we credit interest payable. The final, at year end, there is an $1,800 debit balance in the supply account. Only $700 of supplies remain on hand. So if we only have $700, that should be the balance of our account. So we need to show that we used up $1,100 of those supplies. So we debit supplies expense for $1,100 and credit the supplies account $1,100. So that is how we complete those adjusting entries. Please make sure you ask me any questions you may have on those. The second part just wants us to show, hey, what if we never did these adjusting journal entries? How much would our net income have been off by? Well, take a look. If we never did these journal entries, we would have never recorded this interest revenue of $600 or the rent revenue of $2,000. So our income would have been what we call understated by $2,600, not enough. If we never fixed that insurance expense journal entry, we would have overstated our expenses by $1,500. If we never recorded depreciation, interest, or supplies, we would have understated those expenses. So overall, our income statement would have shown too much in net income of $3,600. 2 revenues never reported, 3 expenses never reported, and 1 reported too much. So please take a look at that and let me know if you have any questions. And that's why we have to do them. We have to make sure all the expenses that have occurred are recorded, and sometimes we've got to search for them. Okay, and that's what adjusting entries result. We get you used to the typical types of adjusting journal entries through our theory here, but in the real world, we know the typical type of items that may be missing. So now we know what to look for. Okay, and if we don't record them properly, we're not representing the true financial activity for that period of time. Okay, so I do apologize again for that problem with the video. So please let me know if you have any questions on either of these problems.